Yeah, thank you very much, Apurva. For the next session, I'd like to invite, which is on VC investments in India, I'd like to invite Anjani Bansal from Global Brain, Lavanya from Trifecta, Mohanjit from Iron Pillar, Rajan from Sequoia, Sagar from Beams FinTech, and Tejesh from IC Universal Legal to moderate this panel. I think the panelists are networking. Allow us a couple of minutes to get them back to the stage. The panelists have entered the hall, so I'd like to re-invite on stage Anjani from Global Brain, Lavanya from Trifecta, Mohanjit from Iron Pillar, Rajan Sequoia, Sagar, Beams FinTech, and Tejesh from IC Universal Legal to please come on stage. And I'll thank you, Tejesh, for accepting to moderate this panel. I'll hand it over to you, Tejesh. A round of applause, ladies and gentlemen.
Testing, testing.
All right. Thanks, Amit and IVCA team for the kind introductions. Good afternoon and a very warm welcome to all my panelists here and everybody out there in the audience today. As a moderator, could not have asked for a better panel, and thanks to see a near full house here, right? So with the stellar sort of a starcast I have got on the panel with me today, over the next 40 minutes, I am going to deep dive into a lot of relevant burning questions which are present before the VC industry here today, right? Including but not limited to the LPGP relationship, the investment environment, the unit economics, the profit versus a burn question, investment environment over next 1 year, and whatnot. So anyway, without further ado, let me throw the first question in my series of questions to Rajan first. Rajan, the question which I have for you is pretty burning as a topic, and it's not agnostic, I would say. It's agnostic to the industry, be it private equity or venture capital, right? And the aspect I'm talking about is the governance aspect. I'm talking about the ESG. So for you as an investor with a portfolio and a very large portfolio full of unicorns and unicorns, right, with a potential for a listing at some point, how do you think how critical the governance and ESG has become when you deal with the portfolio entities? And as far as dealing with founders is concerned, how do you see that the transition is smooth from being a private enterprise to a public enterprise when these founders actually will see a heightened sort of a public scrutiny? They will see so many regulations from regulators, say like the Securities and Exchange Board of India. So how do you ensure that that transition is smooth and it doesn't create a hole in the pocket, both for the investor as well as the founders and the companies? Over to you.
Yeah, thanks. Thanks for hosting us. Great to be on the panel with my esteemed panelist. Hi, everyone. So I think you've asked many questions there. Maybe I'll try to answer one or two out of those questions.
Sorry about that.
Look, firstly, you know, the whole goal I think all of us have is to build world-class enduring companies, right? Companies that can go for 20, 30 years and have an impact on the world. And to build a world-class company, you need to have world-class corporate governance. And I think what we are seeing in India over the last, call it 12, 15 months is a few situations, right, where we've had willful fraud. So I think the first thing to keep in mind is, at least for our firm, and I think I speak for many firms, when you see willful fraud, you have to take action, you investigate, you take action. Now, moving on from there, how, you know, the question really is, how do you make sure that startups from their very early stages of their journey, number one, are aware of what good corporate governance is, and number two, put in place the stage-specific set of things they need to do to ensure that they have corporate governance. And of course, when you get to pre-IPO and then IPO, it's very clear what you need to have, right? I mean, you can't be a public company in India, at least as a startup, without having an independent CFO, without having the right set of committees. But I think the area that, as an ecosystem, we need to focus on, we as a firm are focused on, is really at the much earlier stages to make sure that, you know, our founders and also our investors are deeply aware of what are those sets of things that need to be put in place to ensure that there's great corporate governance, right? By the time you raise a Series C, you have to have an independent CFO, right? You have to start thinking about, if you're not putting in place a set of audit committees, you should be doing external and internal audits. You know, you have to have independent board of directors by the time you're Series C or Series D. Now, on the other hand, you know, if you're a seed stage company, you should not have independent board directors, right? Because that's probably too early for you to have, because if you're just trying to find PMF. So what we're really focused on is at different stages, and I think this is where the ecosystem is really what we're up to, is at different stages of a company's journey, how do you make sure that you have the right set of processes in place? I think that's the big focus. So simple thing like get your audits done on time. Not finishing your audits on time is not acceptable, right? How do we really drive that at a level of detail? Now, all this being said, look, at the end of the day, founders, you know, have to be aware of what needs to be done. They have to do. Investors have to make sure we are partner with founders on ensuring these things happen. But, you know, venture capital is a business of trust, right? At the end of the day, we trust our founders. We are in a partnership, in a long-term partnership. And I think what has happened, unfortunately, is there have been a few situations of willful fraud, where at least as a firm and the boards that we're on, we've taken action. That's been quite challenging in many different, but I think we'll continue to do that. So, but I end with this way, which is where I started. Building world-class companies requires world-class governance. You know, I was hosting Sanjeev Bikhchandani last week at a Surge event, and Sanjeev says, look, 25% of InfoEdge's stock, you know, market cap is attributable to great governance. That's fantastic, right? I mean, that's just one example of the benefits of great governance. But we know what not having good governance does. You know, you're no longer running your company most likely will not survive. And, you know, the bad things happen, but the good things that can happen because of great governance are quite extraordinary.
I think one follow-on question I have for you, Rajan, since we have the benefit of you being here, and I'm pretty sure a lot of people here out in the audience will have the same question at what's the VC mindset when they do things in a particular manner. For example, quite a few of them, I think we are having this conclave after a good long gap, and a lot of people would have binge-watched on a lot of series and movies. So I'm giving an example of quite a few people would have seen We Crashed, for example, right? And how do you avoid those kind of scenarios in which an investor is giving you a $47 billion sort of a valuation, and then when you are going to go public, in the public prospectus in US, you have so many disclosures on the conflicted transactions, the governance issues, the relatives of the founders occupying the key positions, no visible path of profitability being there, and suddenly the valuations nosedive. But the interesting part there is that the founder who is ousted has a huge severance payout, exit payout. And second, he would suddenly start a new venture and which will have a pre-revenue sort of a valuation of $1 billion because a Silicon Valley VC firm is going to pump in $350 million immediately and the venture is not yet out in public. So are we missing something here that what sort of a mindset, what's something the VC firms like these are seeing which as a layman we are not able to?
I mean, look, again, there are many questions there. I think what, I don't, by the way, that particular example, you should ask the investors who invested in the new company, right? We did not, our US team did not invest in that company. But in general, look, I think what we'll find is you have to also separate fraud from having run a company into the ground because of either mismanagement or markets have changed, right? At least as far as I know, WeWork has not been in the fraud bucket.
That's right.
But I do think companies that are clearly in the fraud bucket, those sets of founders will find it very, very difficult to raise capital from institutional investors. Because as an institutional investor, how do you actually invest in a founder who has, in a previous avatar, committed and found guilty of fraud? I mean, that's a pretty extreme thing. So I think we should separate, very high valuations from other set of things that have happened that were not great governance, but quite frankly, maybe poor business building, right? So that's number one. I think number two, look, valuations, I mean, we went through 18 months of, or actually several years of zero interest rates. It's not just WeWork, right? Like Zoom is down 90%. I mean, most public tech stocks are down between 50 and 80%. So I think we should separate out, public, valuation corrections from founders who maybe didn't manage their businesses well enough to fraud. And I think the big concern really is when you have serious corporate governance lapses that are then investigated and concluded to be fraud. I think those are super, super serious. And at least one of the things that, I sort of say is, look, willful fraudsters have a way in which they can hide lots and lots of things, including from big four accounting firms and the best law firms in the world. And how do you catch them? It's very, very hard. So you have to double down on diligence, you have to double down on governance, you have to do all kinds of things.
Wonderful. I think that's a very critical sort of an observation. I think you need to really separate fraud from maybe there may be a disclosure issue or something like that, right? So thank you so much. And my next question is for you, Mohan. How are you looking at the LP-GP relationships over past some time, right? In terms of the carry terms, the catch-up terms, the management fee, and how's the relationship with the LPs growing? Are there more demands on transparency? Are you interacting with your LPs more on the health of your portfolio entities or on the prospective investments are you going to make? So any shift you have seen over last 1 year or 2 years globally?
So thanks again for having me on the on the panel. Whenever I do these panels, by the way, my goal is twofold. One is to say things that are obvious but make the audience think they are not. And then the other is to be a little bit more provocative than usual. So let me try both of those. So look, there are three aspects to the questions you asked. One is sort of market dynamics. Second is that I'll hit on is DPI, and the final is NAV, and I'll peel the onion. So in terms of sort of market dynamics, right? You asked the question about shifting terms. Look, 2 and 20 is sort of the standard, right? Early investors coming in as early anchors or first close investors may get a break. Now, what I do want to do, given the time that we're living in today, I sort of build a little bit of parallel to the GFC. So what happened during the global financial crisis, from a Silicon Valley perspective, by the way, there were several firms that had 2.5, 25, or 3 and 30 terms. Very atypical, but given the brand that these firms had, they were able to get or garner those kind of economics. Now, that's all great when things are up and to the right. You keep raising newer funds, more AUM, wealth creation for managers happens from fee, not from carry, right? Provocative, but true. Similarly, I think what's happened, COVID, V-shape notwithstanding, a lot of that has also happened. Larger and larger funds get raised. Fee income goes up, portfolios balloon, and then you have a hiccup. right? When that hiccup happens, that's when the LPs get the leverage, right? Leverage shifts perhaps from GPs to LPs, and they start asking questions around, wait a minute, we've been investing, you've been getting fees. I'm not saying in India, for example, the 2.5, 25 or 3 and 30 model, I don't think it's prevalent. But I was there during the GFC times in Silicon Valley where all of a sudden the 4 to 5 week fundraising cycle where one partner had to make N number of calls and a $500 million fund happened, turned into an 18-month cycle with a fund size being reduced by 50% and the 2.5, 25 or 3 and 30 going away. So I think we're in that moment where LPs are starting to take a look a little bit more closely, and the shifting also has happened from, let's say, TVPI to DPI, right? And the DPI conversation, by the way, this is a very difficult time to have that conversation. Why? Because IPO windows are shut, M&A is actually happening at a discount, not at a premium. So there's a lot of secondary activity, right? That will continue to happen because funds that are sort of in their second half of their 10-year fund cycle or towards the tail end may not have a choice but to go down the path of exiting through secondary. So part of your question, the first question is really that. And the other aspect I'll spend 30 seconds on is the NAV, right? So I'm from Delhi, right? So family was in the jewelry business many, many moons ago. So there's a Karol Bagh Gold Jewelry Association. What happens? They were the first guys who actually came up with AI. What I mean by that is when gold prices go up, there is an AI in the background which in a nanosecond increases the price of that commodity. But when the prices go down, there's a massive lag. Similarly, there's a public to private lag and private to be honest, the VC NAV lag. And so last week I had conversations with 2 CFOs of Silicon Valley prominent firms, and they said right now, that is the conversation that's going on, is where do we value these companies that clearly are sitting slightly or massively inflated, and that sort of pushing and shoving is going on both internally at the GP level and between GPs and LPs. So I think that dynamic is playing out. Now, the other thing I will say in terms of communication frequency and what type of communication is happening between GPs and LPs, one of my pet peeves as a board member, for example, with entrepreneurs is I hate downside surprises, right? So when I go to a board meeting, I do not want to see a downside surprise. When there's something that's going sideways or going down, I want the entrepreneur to reach out to the board members, to the investors, and say, hey, I want to just give you a heads up before you read it in the papers or before you hear it in the board meeting. Similarly, I think to bring trust, governance, what Rajan talked about, and to really build a 15, 20, 25-year relationship between GPs and LPs, that communication, that trust, if things are indeed going sideways, bring it up earlier rather than later. So I think that is happening, and LPs appreciate that because they know that this is a long-term business and not transactional. By the way, one of the lines I use is you can divorce your spouse, you cannot divorce your investor, because that's the relationship you're going to have for 10, 15, 20 years. So anyway, I hope I've answered in somewhat a funny way. Yeah, what happens in Mumbai stays in Mumbai.
No, all right. I think early days, Mohanjit, just one question, because coming back to what we saw in the movie Big Short, right? You had Christian Bale playing Dr. Mike Burry, a fund manager taking a very contrarian bet than what general market will perceive, right? And investors coming and questioning your wisdom that what kind of bet it is. What kind of bet it is, you're not, so just to repeat, I'm quoting that have you ever had a situation wherein an investor has actually questioned you that, Mohan, what kind of contrarian bet you have taken? And actually the bet you have taken has come good and you had the last laugh.
Look, there are several examples. I mean, it depends on the stage of the company that you invest in. So my journey, for example, started with early stage. I mean, really early stages, PowerPoints and so on. That's when the contrarian view was worked out for me in particular, just betting on 2 guys in a garage out of a place called Boulder, Colorado on something called IP storage when IP storage was not the thing. and investors questioned it, but it became actually the largest exit for my very first firm called Garage back in Silicon Valley. So that's an example. Having said that, if you are, let's say, a mid-stage firm like we are now, investing in Series B and C, and if we have raised capital from our LPs based on a particular strategy, and if there is a sectoral approach that certain funds have, and if you end up going completely polar opposite or orthogonal to that, just make sure that the LPs are comfortable, that they've given you the leeway for that 10, 15% that's discretionary. Go and experiment rather than, again, I mean, you look like a hero, right? If you do it without them knowing and it's a success, but otherwise it becomes challenging.
I think takeaway is timely disclosures, transparency, keeping them informed, no surprises. I think that's the takeaway. Lavanya, coming to you, Trifecta is a sector agnostic fund. As a VC, which are the top 3 sectors you are looking at which are definitely going to perform in your sort of view, in your opinion, over the next 1 year? And second question is that for a late stage investor, VC investor like you, how are you seeing the exit environment for next 1 year?
Sure, absolutely. Thanks so much for having me. It's lovely to be here. And Tejish, it's really hard to pick 3, but I will try. I think the 3 where we're seeing a lot of momentum over the last year, correction notwithstanding, is certain elements of fintech. SaaS continues to be very strong, and ag tech. And I'll spend a couple of minutes on why we think these 3 segments are particularly interesting. I think taking the last one first, if you think about ag, it's just a really large market, contributes maybe 17% of GDP, give or take. And if you think about just the output side, that's in excess of 330 billion. And then 58 billion of inputs contributes to that output. So really large market and really ripe for tech-powered disruption because there's multiple parts of the ag value chain that have been broken over the past. And we think there's some really interesting work happening through this value chain to fix some of these supply-side linkages, to help with offtake. And we've seen in the 4-year period from, say, 2015 to 2019, we saw ag tech GMV grow up maybe 3 to 4x. But in the last 4-year period, we've seen that 10xing. So there's been some really good growth stage momentum in ag, and we're starting to see really good unit economics around these emerging. This has been maybe 6-8 years in the making. So this is one sector we're spending a lot of time on. We think fintech continues to be very interesting. I know this might be slightly contrarian at the moment, given there's been a number of regulatory shocks. And we've dodged a few bullets there as well. We spent a disproportionate part of the first 18 months of sourcing on fintech because there were multiple companies that were growing very quickly and seemed to have, in the near term, very good unit economics. I think we dodged a lot of those on the valuation principle, less on actually the regulatory risk. We didn't see this coming this fast and this furiously. But we think within fintech, embedded finance is an area that's very interesting. We're starting to see a lot of deal activity there. We think banking infrastructure and banking as a service is continuing to be very interesting, and neobanking as well. So spending a fair bit of time on those segments. InsurTech continues to be, given how underpenetrated we are. We had the chairman of IRDA talking earlier about how he's going to push the digitization agenda very strongly. So we think that's another very interesting area. So broadly defined fintech, again, seeing a lot of momentum. And this, by various accounts, could be a 1.3 trillion opportunity in itself in the next 5 years. So very large, cannot ignore it overall. And then SaaS continues to be a really interesting piece of what we think growth stage VC could look like. About 70% of the activity we've seen so far has been in horizontal businesses. We're seeing some very interesting trends around horizontal infrastructure and vertical businesses as well. So spending a fair bit of time on that. And I think they're truly building in India for the world has become a opportunity that's truly come of age. If you look maybe 4 or 5 years ago, there was maybe one company that was north of 100 million ARR from India SaaS. You're now seeing at least 14, 15 of those, and Mohanjit is in some of those. So I think we're starting to see really good independent scale as well as very strong unit economics. So very excited about those 3 segments. And then you also asked me about the exit environment. So this reminds me of, when I was an investor in TVS Logistics, in the first wave of logistics investing in my previous avatar, the chairman of the board, it was year 4 of our investment. We were supposed to start preparing for an IPO. And it was also when the economy was not cooperating. We didn't think it was a good time to list. And so the chairman of the board said, look, you get to do this only once as an entrepreneur. And so you better do it right. You be prepared. And then when exit windows open, you get ready to take them. Right? So this is the advice we're giving our portfolio. We're also lucky. We came of age just 2 years ago. So we have a 5 to 7 year growth stage investment cycle. So we're in the deployment phase right now. Of course, you have to keep one eye on the exit door as you come in as a growth stage investor, because one of the promises we make to our LPs is that we will be very focused on making investments where we think there is a path to a permanent source of capital in a finite period of time. But we think the exit environment will likely pick up in the next 12, 18 months. We stress, like Rajan said, like Mohan said, on governance to our companies. We stress on preparedness. And then when windows open and you're ready, you can take advantage of a permanent source of capital.
Wonderful. So a lot of us here are angel investors, actually. So a lot of good insights on SaaS. You are talking about the banking finance, the fintech you're talking about. So thank you so much for that, Lavanya. Coming to you, Sagar, my question to you, you have raised an India fund. You are dealing with SEBI right now. What's your take on the SEBI regulatory regime? You have seen it evolving over a period of time. Do you think so many recent changes which have been carried out, do you believe that there are knee-jerk reactions? It's becoming a little difficult for the GPs actually to ensure ongoing compliances, and the chances of inadvertent sort of non-compliances are getting bigger. And second, of course, my question to you is that are you seeing significant amount of domestic institutional capital being raised, which means the reliance of Indian GPs on the offshore capital is reducing to a good extent, right? Because you are seeing the insurance regulator, the pension regulator, they are opening up the investments. Government has come out with so many sector-focused funds, right? The sunshine sector ones, and in the budget we had a dedicated agri fund which may be notified soon. So that's the second part of my question. So over to you.
Thank you so much, Tejas. Thank you, my co-panelist. Interesting question. Being a domestic fund, obviously, we have to go through a lot of regulation and compliances. I think we should first thank SEBI for being so proactive, and not only proactive, but also regulating and monitoring all the AIFs. We have more than 1,000 AIFs today in India, and the regulation is only 10-year-old, right? So in 10 years, if they have approved, regulated, and monitored more than 1,000 AIFs, it's a commendable task. It's a Herculean task, right? Also, not to mention IVCA and you guys, IC Legal, you guys have been constantly the flag bearer of our entire industry, private equity and venture capital, making a representation on our behalf, going and talking to all these institutions and making them recommendation on our behalf and representation on our behalf, what makes sense from an international perspective. Given that it's a 10-year-old jurisdiction, it's still new. I think regulations do evolve. Global jurisdictions like Cayman, Mauritius, they've been there for more than 2 or 3 decades, and they've been evolving. They've made multiple reforms, amendments. Is SEBI going to, or the regulatory regime in India evolving? Certainly yes, right? I think it's evolving. There's always a challenge between regulating and making sure that there's no unintended consequences of the same on the industry, right? It's very difficult. Is there changes required in certain regulations? Absolutely. There are a few items which I personally think can be definitely improved, and I'm sure a lot of you guys are making the representation, especially on the valuation of portfolio companies. We're talking about harmonizing taxation between management fees and carried interest in the domestic sense. As I think Mohanjit mentioned, valuations play a very important role, right? So that needs to be addressed in the right fashion. Protecting the interest of the investor is also very important. But these are all evolving, right? I think India is still 10-year-old jurisdiction. It is evolving. I think there is a difference between being light touch and at the same time conducive. We need to give a little bit more flexibility to the managers, trust their investor base, the LP base that we all have, right? We have both a combination of domestic institutional investors and international investors at the same time. So we are following all the best practices. Will it evolve and become more friendly to the fund managers? Certainly yes. Is it going to happen immediately soon? Of course not. But we continue to believe that SEBI has done a good job, and it's going to get better for us going forward. That's the first part of the question. Coming to the second part of the question, domestic pool, certainly yes. I think if you look at the total AUM that's being managed by AIF, it's $90 billion in India. That's the assets under management. It's a combination of international capital as well as domestic capital. 80% of that capital has come from international investors, and 20% of that capital has come from domestic investors. It's a sizable pool. Is it still enough? Of course not. There's an acute shortage of domestic pool of capital. Can it be increased? Yes. Do we need encouraging environment for banks, financial institutions, pension fund, endowments, better taxation norms, more floor than ceiling to encourage these institutions to deploy capital in private equity venture capital? Certainly, yes. I think if you look at US and Europe, right, 40 to 45% of the capital sometimes from the pension fund and endowments go into private equity venture capital. In India, we're still talking about 5% cap, right? So we're far more behind in terms of evolving, yet I have to give due credit to institutions like SIDBI. They've done a phenomenal job. They've deployed close to $1 billion in 175 plus funds. So that's a sizable capital. SRI is doing a good job. MeitY is doing a good job. Technology Development Board is doing a good job. So there is enough and more pools come in, but is it enough? Definitely not yet, right? So I think from a 10-year perspective, if you want to really boost the domestic ecosystem and mobilize a large amount of capital, you need more pools of capital. You need government to set up more fund of funds, probably family offices to become more institutionalized at the same time. So it is definitely available, but can be much better in the next 10-year perspective.
I think just to give some numbers, when we are talking about pension regulator, insurance regulator, right, with the amount of ceilings they have got and the investable surplus they have, which they can invest in alternatives, it's 2 lakh crore of money which can actually get poured into alternatives in India. That's the real number actually we are talking about. And when you really see what's the amount of investment which has happened, is minuscule. When you look at what Silicon Valley sort of insurance firms and the banking firms and pension funds have done, or the CPPIBs of the world or CDPQs of the world have done in India, I think compared to that, we have really not seen anything in India yet. So I think there's a lot to come, and the great news for the alternatives and the kind of work government is doing, I think is commendable on that front.
Just to add to that point, right, I think the difference between US or a developed market like US and India is that in US it's more board-driven policies, and in India it's more regulation-driven policies, right? When you start moving from regulations to board-driven policies, you'll see a lot more capital coming to private equity and venture capital as well.
Wonderful. Thanks. Anjani, before I raise the question to you, I would like to put a few facts, right? Morgan Stanley predicts, for example, I'm talking about India. They say India is going to be one of the 5 large economies over the next 1 decade, right? And the annual output growth will be in excess of $400 billion, which will be only 1 out of the 3 economies which we will see in the next decade. A lot of people are saying don't bet against India. The McKinsey CEO on record said, forget talking about the decade of India, the entire century belongs to India, right? And we had an aircraft deal which happened last week, and you clearly saw the Brit Prime Minister, you really saw the US President actually coming on board and saying that India is directly or indirectly creating employment actually in UK, US, you're talking about the French, again, the Supremo said the same thing. So are people looking at India differently? Because you are raising a lot of global capital, right? From Japan, you are raising significant capital. So how are your LPs looking at India right now? And has something changed over the last few years? And what's your investment horizon over the next 1 year when you are looking at global capital coming in India?
Sure. Yeah, thanks, Tejesh. While I fully agree with everything you said, I will take a cue from Mohanjit and try to be a bit provocative. In Japan, there is a proverb which says, "Sara mukhi kara ochiru," which essentially means even a monkey can fall out from a tree. Essentially to say that while we all believe in the growth capital or growth potential of India, none of this is inevitable. A lot of work needs to be done, a lot of things need to be in place for us to be able to harness that potential. So we actually internally believe that given where India is today, watchful optimism is more pertinent than unbridled enthusiasm. Having said that, Japanese LPs, which form bulk of our investor base, are in the same mindset as other LPs. They fully see the structural scaffolding that India has put in place. It's not lost on anyone, the growth potential, and are realizing that India has to be a really important part of their overall asset allocation. Having said that, LPs look at India differently. Some LPs we have are more about harnessing the growth potential. So they look at the market size, the talent which is available in India, and therefore the ability to harness the financial returns that are possible. But then we also have LPs which are global corporates, and they are looking at India as an opportunity to harness the innovations which are happening here, which are also applicable to markets in their countries. For example, one somewhat unexpected sector is financial services, because we usually expect financial services to be bespoke to a country. But we have LPs who see opportunities in their countries because their banking systems, payments, even wealth management systems are behind where India is. And so they're looking at startups in India to port that over into their geographies. And then we have a category of LPs who are looking at India for, as a source of almost like global growth, where certain sectors like climate tech, space, life sciences, there is an opportunity for India to lead the way for solving some of the large problems globally, not just for India. And then I will also say one thing that, there's also a scenario of handling misinformation. Given what has happened over the last few months on both public and private markets, with not so favorable news coming out of India, there is a risk where information biases get created. Bad news always travels faster. So I might find myself spending a lot of time just correcting that narrative based on facts that we are seeing on the ground, to make sure LPs don't get carried away with and things don't snowball into something that they are not. But having said that, really most of our LPs think that today is like the 70s moment of Silicon Valley. It's today in India. And for entrepreneurs, investors, engineers, there is no more exciting place to be.
Cautious optimism, basically. All right. I have one last question for each one of you, and it's pretty straightforward because we have a lot of fund representatives here from micro VC investing stage till late stage investing, and a lot of people are talking about a funding winter. But is it really happening with all the funds when they are raising LP capital, or is it happening with all the sectors actually where the portfolio companies are in, or we are seeing a varying sort of environment, right? Where somewhere there is a funding winter, somewhere there is not. So quick 1 minute sort of insights from each one of you at what your funds are seeing in the market, and quick 1 year investment outlook. We can start with Rajan, maybe in the same order.
For me, there's summer all the time, my friend. So look, growing up, my mom used to say, patience is a virtue, right? That's a very well-known saying, and now I give the same gyan to our entrepreneurs. So I'll give you a couple of examples. We've had in recent months 2 very large deals. One was a $125 million check that disappeared after the red lines and the final documentation. Right? This is not at term sheet level, this is at final docs. And then we had another where it was a large sovereign that ended up doing the same thing. So we are seeing what may seem like unnatural things happen very naturally in terms of our portfolio companies. So is winter here? No. So we have 6 companies in our fund 2. 4 of those 6 have done up rounds in the last 12 months, right? So clearly, companies that have product market fit, unit economics, all the things that you've heard throughout the day are getting funding, but it's clearly taking longer. Diligence is longer. So I would just say that no, it's not winter. It's not quite global warming either, but it's on. So here's another analogy just to make it a little bit funnier. So there is a stick to carrot spectrum. My wife calls me a frozen carrot. So that means it takes a while to thaw me out, right? And that's really how I would describe the current fundraising environment, both for GPs and fund managers, by the way, and for entrepreneurs. So with that.
No, thank you, Mohanjit. Interesting. I think two large deals happened in India, right, last 10 days. One was an announcement of PhonePe raising $100 million at $12 billion valuation, and then it was a series A of $150 million by Insurance Deco, right? I think that's one extreme of it, right? Second, I can just tell you from my portfolio companies, as Mohanjit mentioned, both our companies raised subsequent round of capital last year at a higher valuations, again, talking about the quality of the companies. So I always believe that good companies will get good capital from good investors and at good valuation. It doesn't matter whether there's a winter or a summer, companies should be good and quality should be good. Coming to on the fund side, right, as we are raising capital on the market, I think there's a clear demarcation in the fund market between fund managers with a lot of track record and fund managers with a lot of niche strategies. I think we probably fall in the other bucket, which is a lot of niche strategy, right? We're the only fintech-focused fund today in India, as we can say. So there's a niche demand in the market for a new strategy. People are done with Me Too strategies or similar business models. People want to look at very similar to companies, newer funds with newer strategies, with a lot of depth in what they're doing at the same time. So there is capital available depending upon what you're raising for.
I think Tejish at growth stage, right? Candidly, there's not a single company I have loved that I've evaluated in the last 18 months that's come cheap. And so for good companies, I think in this country, there will always be some type of scarcity, governance, premium. And so our thesis is it's hard to buy good and cheap. You can buy cheaper than you did in 2021. But in absolute terms, if you look at global multiples, to buy cheap in this country for a category leading asset is always very hard. And so I think the way I would characterize the activity we're seeing at growth stage is cautious optimism, like my fellow panelists have described. There's a lot of evaluation. There's a lot of founder trust building. There's a lot of diligence that is happening. But I think timelines to closure have elongated. And both funders and founders are more patient in high quality assets to try and get to an outcome that seems fair for both sides. That is taking longer today, right? But I think it's not a funding winter at least. I do think though, in terms of how in aggregate valuations correct, there's a little bit of a slow Mexican wave, right? Public markets correct very quickly. You get a report card every day. Pre-IPO funds then start to correct because whoever was supposed to buy that paper is now paying a lot less for it. Growth stage funds correct with a little bit of a lag. And there's a lot of growth stage companies that raised a lot of money in 2021 and the first half of 2022. They want to grow into what they think is an appropriate valuation for the next round. And if they don't want to raise now, if they default alive, they have enough money in the bank, they can see that path to profitability, then it's hard to convince them to transact in a muted environment. So I think that's sort of what we're seeing.
Great insights. Anjani?
Yes, I think I agree with the points that were just made. For us also, a lot of our LPs are global corporates. So there isn't essentially a funding winter. This is patient strategic capital and very bullish on India. However, we are seeing a higher scrutiny on valuation relative to global peers. And that's where it's our role as fund managers to explain the implied premium in Indian markets because of the growth potential, scarcity value, and so on. Having said that, at a tactical level, we are fully focused on companies in our portfolio which need to raise cash in the next 12 months. I think that's going to be tricky, so we are doing all we can to make sure that companies that we believe in are able to ride through the liquidity issues that may come up. But at the end of the day, I think no matter how we twist and turn for LPs, they always come back to risk-adjusted returns, which are globally benchmarked. And I think that's where we have to keep our focus.
Yeah, I'm a raging optimist on India. There has never been a better time to build, and there has never been a better time to invest in India, right? You know, from an investor standpoint, we should separate early from growth. The seed and venture markets are very active. I'm back to having 4 to 5 meetings on every Saturday and Sunday. It's not 2021, but it ain't June 2022, right? So I think the seed market is very active. As a firm at Sequoia, at Surge, we are very active. Actually, next week, we're going to reveal our new cohort. Our venture team is very active. I think in growth, as you just mentioned, things are slower in growth because the best growth companies in India have raised a ton of capital at 2021 valuations. So either they're going to grow into those valuations or they're going to do down rounds, but you're not going to do down round when you have a lot of capital, right? So I do think it's going to take some time before the growth markets come back. But from a growth investor standpoint, I look at India at $3.5 trillion GDP. 2 trillion of that is domestic consumption. Over the next 7 years, India is going to have $1.5 trillion of consumption. So if growth investors, including our teams who are investing in growth, can't find a few companies that are going to generate $500 million of revenue, what are we doing here? So there's going to be, I think, a short period of time when where companies are going to just not raise because they have so much capital. But I think that period will come and go, right? And I think to your point, look, you can't buy cheap if you want to buy great. Great and cheap are not in the same sentence, right? So, and in India, the reality is, look at HUL. HUL trades at what, 60 times PE? It's a phenomenal company. It trades at $70 or $80 billion market cap. So the reality is, if you want to invest in great companies, you have to pay up, right? And the last thing I would say is, look, this year, in many ways, this whole winter, like, I don't understand what part of $25 billion coming into the Indian ecosystem feels like a winter, unless you were born like 3 years ago, right? I mean, in 2010, we had less than $1 billion coming into the Indian startup ecosystem. Yes, compared to 2021, where you had north of $40 billion, $25 billion seems a little lower. But compared to a decade ago, we had less than $1 billion coming into the ecosystem. $25 billion seems like a tsunami. I mean, the whole city is drowning in capital. So I do think, and that being said, by the way, this year might be less than 25 billion, but it's still compared to $1 billion. 10 billion is 10 times. 10 times in 10 years is actually a significant amount of growth. And I think the last thing I'd say is, look, there's just, which is what I started with, there's just never been a better time to invest. Because the kind of companies that we're seeing, the kind of entrepreneurs that we're seeing who are starting up now are just literally 10x better than the founders who were starting up 3 or 4 years ago, right? And I think what we'll see in the next 12 to 18 months is our ecosystem is going to get profitable. Every media outlet now likes to talk about where are the profitable unicorns. Well, just wait 12 months. They're going to get, no, because, Indian entrepreneurs are extremely agile. We have the most agile entrepreneurs in the world. It used to be they could raise capital. All my friends, they could raise capital, and you could drive a lot of growth. You could not make any money, and you just keep raising capital. No more capital. So what are you going to do? You're going to get profitable. That's why you'll see, starting with the public companies, they'll start getting profitable. And, I think as growth investors, you're going to have a field day next year because there are going to be so many profitable companies, but they are not going to be cheap.
Absolutely. And
actually, can I know we're give me 30 seconds just to double click on what Rajan said.
Come on, you have to be a raging optimist. You can't come to India all the way from Silicon Valley and be moderately optimistic.
No. I am echoing exactly what you said, but I'm going to give a specific example. So I moved to India in 2007. I spent 5 years in Bangalore. And back then, I was struggling to get entrepreneurs to think about getting to 20 million, 30 million, 40 million in revenue, right? And forget about unicorns and all that. What's incredible, and Rajan and others will echo this, is now these same entrepreneurs, or this new generation of entrepreneurs, are thinking, forget about $1 billion in valuation, they're thinking about $billions in revenue and profitability, right? So that's not a 10x improvement, that's a 3 orders of magnitude improvement in the overall mindset. And I think that is why, I've talked to a bunch of folks who are now relocating to India. I'm going to start coming here on a very regular basis. We've got a large team here, et cetera. But that's precisely, I echo that completely.
Mohanjit, when you were here, there were no internet users. Today, there are 700 million of them monthly active. I mean, it's crazy. You should move back. It's time.
Raging optimism. I believe it's raging optimism. And on that optimistic note, if we can take a couple of questions if time permits, otherwise, I think the amount of insights we had, I think all the questions would have been answered, I'm assuming, right?
Time's up.
Time is up. All right. So, all right, thank you so much, and a round of applause for the panelists here. Wonderful insights, and have a great day ahead, all of you. Thank you.